Freaking out about the stock market right now? Take a deep breath, watch this video all the way through, and you'll come out feeling a lot better on the other side. Let's get into it. Hey everyone, my name is Arjun and welcome back to the channel where we talk about all things investing. Well, there's really no way to sugarcoat it. Since my last video, the markets have continued to get worse. All the major indices have seen several straight weeks of declines with pretty much no letup. For those of you not fully aware of what's going on, let me break down exactly what's happening. The inflation report for May came in recently at 8.6% year over year, yet another 40-year high. Everything from hotels to groceries to gas have all seen huge price increases recently. How did we get here? Two reasons, in my opinion: stimulus and interest rates. In response to the pandemic, the Fed printed a whole bunch of money and gave it out first to businesses in the form of loans and then to people in the form of stimulus checks. When people received this money, they obviously went out and spent it. No judgments. When there's more money chasing after the same amount of goods, then prices tend to increase. At the same time, the Fed also dropped interest rates to fight the economic slowdown. The cheaper it became to borrow money, the more people were tempted to go out and buy stuff like houses and cars. The Fed noticed this going out of control and said, hey guys, it's time to rein it in. And they increased interest rates by 0.75% this past Wednesday. They also mentioned more upcoming rate hikes in the near future. The idea is that increased interest rates makes it more expensive to borrow, leading to reduced demand. The hope is that low demand reduces prices and thus finally brings inflation back down. But investors think that these moves are a little too late and the severity of them could push the economy into a recession. This sent the markets tumbling further, bringing us to where we are today. If inflation isn't kept under control, company earnings get worse, supply chain bottlenecks continue, and the war in Europe rages on, then it wouldn't surprise me to see further drops coming up ahead. Despite the short term looking pretty bleak, I've mentioned multiple times on this channel how important it is to have a long-term approach. The market, as we've seen, can fluctuate pretty wildly on a day-to-day basis, and that's completely normal. All of this choppiness tends to even out over time. If you're not fully convinced, let's look at 90 years of data to put your minds at ease. I downloaded S&P500 data dating back to 1930 to compare the historic odds of making money by different holding periods. Whew, that was a mouthful to say, but I promise you it's not that hard to understand. To begin with, let's look at the odds of making money on any given day. Data tells us that it's equivalent to flipping a coin. 50% chance of making money and 50% chance of losing. You're pretty much gambling at this point. When we look at holding for any given month, the odds improve slightly with a 64% chance of making money. Again, this just means that in all of the months since 1930, 64% of them gave us positive returns. This is better than holding for a day, but the chance of losing money is still high enough to not be ignored. For any given 1 year holding period, the chance of making money improves to 73%, meaning almost a 3/4 chance. This may sound pretty good, but the returns have ranged anywhere from minus 37% in a year to 53% in a year. So there's still quite some volatility, and you could end up losing a big chunk if you're unlucky. But what's interesting is that when we expand this to longer time periods, the odds continue to improve quite drastically at that. Further increasing out to 5-year holding periods, the odds improve to 87% chance of making money. Looking at 10-year periods, you have a 94% chance of making money. This is why I say you should plan to stay invested for at least 5 to 10 years. This puts you in a solid position to come out ahead. And then finally, for 20-year periods, you would have never lost money. Let that sink in for a moment. Every single 20-year period since 1930, you would end up with more money than you started out with. Returns range anywhere from 0.5% to 13.2% yearly, depending on the period that you pick. This is the power of having a long-term approach to the market. The longer you stay invested, the sweeter your returns tend to be. Despite long-term returns being pretty amazing, it's completely normal to see declines within any given calendar year, like we're seeing right now. In fact, there have been 26 different occasions where the S&P 500 has declined 20% or more. This means, on average, these big declines happen every 3.5 years or so. It's this short-term volatility that tends to trip up the average person into making bad decisions. Smart investors know that all of this is temporary and the market will recover over time. By the way, do drop a like and subscribe if you're enjoying this content. It really does help me out. When looking at stats from long-term investing earlier, an important point to note is that the person stayed invested the entire time, and that is key. Trying to time the market is a loser's game because you could be out of the market during its most crucial days when the biggest returns happen. To illustrate this, a hypothetical $10,000 invested into the S&P 500 15 years ago would have grown to around $46,000. Miss just 10 of the best trading days, and that reduces the amount to $21,000. Isn't that crazy? Miss just 10 out of the 5,500 days? That's just 0.2% of the days, and your returns get cut by more than half. Miss 40 of the best days, and you end up losing 42% of your investment. The solution? Keep investing for the long term no matter what the market does on a day-to-day basis. This is the only way to ensure that you don't miss out on those huge single-day gains that massively compound your returns over time. Despite being aware of this, living through market drops in the moment while it's happening, like we're doing right now, can be pretty scary. Watching your portfolio drop week over week can take a toll on you. So, how do you weather this bear market to come out in a stronger position after? The first thing to remember is to maintain a cash reserve. Having a 3 to 6 month emergency fund in place just gives you some peace of mind, which we could all use right now. It just ensures that in case things take a turn for the worse, that you're covered. Usually, a high yield savings account is the best place to store these funds. Try to become irreplaceable at your job. We're seeing so many companies go through difficult times having to resort to layoffs. Stepping up and showing your value right now is more important than ever. Don't stop investing. Dollar cost averaging right now can work wonders because you get to buy stocks at reduced prices. This improves your profit margins significantly when there's a reversal and recovery. And then finally, go and live your life. Turn off price notifications from apps that constantly bombard you. Go take a walk, watch a movie. Just basically do anything to take your mind off the negativity. This helps prevent rash decisions that we regret later. Keeping a long-term mindset and consistently buying has time and again been proven to be the best strategy. How many times have we thought, dang, if only I could buy this stock at X price? Well, now we've been given a time machine to go back in time and buy stocks at prices that we only dreamed about 6 months ago. You might hear a lot of people say, hey, this time it's different. This is the real recession. But as history tells us, the stock market is not going anywhere. Over time, all the problems get resolved and we're back in an upward trend. Investors who stuck around during bear markets of the past were the ones that were handsomely rewarded during the recovery. Those who quit and left, well, they missed out big time. This is the time for you to decide which side you want to be on. That's all I have for today. Hope you all found this useful. Thank you again so much for watching. I'll catch you in the next one. Peace.